The dark side of investing. Shocking. When it comes to investing, here's the truth. All investments involve some level of risk. Stocks, bonds, mutual funds, and exchange-traded funds can all lose value if market conditions deteriorate. Even conservative, insured investments, such as bank or credit union certificates of deposit, are subject to inflation risk. They may not earn enough to keep up with the rising cost of living over time. When you invest, you make decisions about what to do with your money. Risk is defined as any uncertainty about your investments that has the potential to harm your financial well-being. For example, market conditions may cause the value of your investment to rise or fall. Corporate decisions, such as whether to enter a new market or merge with another company, can have an impact on the value of your investments. If you own an international investment, events in that country can have an impact on it. Other types of risk exist. Liquidity risk refers to how easy or difficult it is to cash out on an investment when you need to. Another risk factor is the number of investments you have. In general, the more financial eggs you have in one basket, say all your money in a single stock, the higher the risk. In a nutshell, risk is the possibility of a negative financial outcome that is important to you occurring. There are several key concepts you should understand when it comes to investment risk. First, there's the risk and the reward. The level of risk associated with a specific investment or asset class typically correlates with the potential return on investment. The logic behind this relationship is that investors who are willing to take on risky investments and potentially lose money should be compensated for their efforts. The possibility of higher returns is defined as reward in the context of investing. Stocks have historically provided the most robust long-term average annual returns of just over 10% per year, followed by corporate bonds at around 6% per year, treasury bonds at 5.5% per year, and cash-to-cash equivalents, such as short-term treasury bills, at 3.5% per year. The trade-off is that higher returns come with higher risks. Stocks are riskier than corporate bonds as an asset class, and corporate bonds are riskier than treasury bonds or bank savings products. Then there are averages and volatility to consider. While historical averages over long periods can help guide risk decisions, it can be difficult to predict and impossible to know whether the historical averages will work in your favor given your specific circumstances and goals and needs. Even if you hold a broad, diversified portfolio of stocks, such as the S&P 500 for a long time, there is no guarantee that it will earn a rate of return equal to the long-term historical average. The timing of both the purchase and sale of an investment is an important factor in determining your investment return, along with fees. However, while we've all heard the adage, buy low, sell high, the reality is that many investors do the exact opposite. If you purchase a stock or stock mutual fund when the market is hot and prices are high, you will suffer greater losses if the price falls for any reason than an investor who purchased at a lower price. That means your average annualized returns will be lower than theirs, and recovery will take longer. Investors should also be aware that holding a stock portfolio for an extended period of time can result in negative returns. For example, the Nasdaq Composite closed at an all-time high of 5,048.62 on March 10th, 2000. The closing price has only recently approached this record level, and the Nasdaq Composite has been well off its historic high for well over a decade. In other words, even if you've purchased at or near the market's peak, you may not be seeing a positive return on your investment. Investors who hold individual stocks for an extended period of time face the risk that the company in which they are invested will go into permanent decline or go bankrupt. According to historical data, holding a diverse portfolio of stocks for an extended period of time reduces your chances of losing your principal significantly. However, investors should not be misled by historical data into believing that there is no risk in investing in stocks over a long period of time. For example, suppose an investor invests $10,000 in a broadly diversified stock portfolio and sees it grow to $20,000 after 19 years. During the following year's market downturn, the investor's portfolio loses 20% of its value, or $4,000. As a result, after 20 years, the investor has a $16,000 portfolio rather than the $20,000 portfolio she had after 19 years. Money was made, but not nearly as much as if the shares had been sold the previous year. As a result, stocks are always risky investments, even in the long run. They don't get any safer as you hold them. This is not a hypothetical risk. If you had planned to retire between 2008 and 2009, when stock prices fell by 57%, and had the majority of your retirement savings in stocks or stock mutual funds, you may have had to reconsider your retirement strategy. Investors should also consider how realistic it is for them to ride out the market's ups and downs over the long term. Will you have to sell stocks during a downturn to fill the void left by a job loss? Will you sell investments to cover medical expenses or a child's college education? Life events, both predictable and unpredictable, may make it difficult for some investors to stay invested in stocks for an extended period of time.